Hello, this is Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 183rd episode. Gosh, just like that, we're stepping into the final stretch of 2026. Time to take stock of where the region stands, especially given the various shocks at play. Our guest is Ethan Wu, Asia Business and Finance Editor at The Economist, where he covers economies across East and Southeast Asia. Ethan is also co-host of Money Talks, the paper's weekly podcast on markets, economics, and business. Before joining in 2024, Ethan wrote financial commentary and hosted a markets podcast at the Financial Times while he was based in New York. Ethan Wu, warm welcome to Kopi Time.
Thanks, Timur, for having me. It's a long-time listener, first-time caller situation, so it's a proper honor to make a debut on the show.
Ethan, it's great to have you. And by the way, if we were in person, I would be handing you this little swag. But it's coming for you, okay? I'm holding it in reserve for you.
Okay. Next time we see each other, that's going to go right in the China cabinet for me.
Brilliant. I'm glad to have you. Ethan, you and I have interacted a lot over the last couple of years. We've done some events together, so it's a real pleasure to have you on the podcast. You cover East and Southeast Asia for The Economist, a region that you and I cover closely, and we're seeing some really historical numbers out of this region. So why don't we start with your take? Characterize the economic momentum this region is going through going into this final stretch of this year.
Yeah, I mean, far be it for me to explain the export numbers to the chief economist at DBS Bank, but I mean, at a high level, it's crazy. It's super robust. Exports are flying. Growth numbers are good. The macro numbers are good. There are exceptions to that, but I think this is the broad trend across Southeast Asia. I mean, it's particularly true in East Asia, where you're seeing growth rates. I mean, Taiwan, I think, just posted 14% GDP growth year over year. Absolutely bonkers. I don't even know how to, it's like when you get past the 100 billion mark with exports, it's hard to even understand how much money you're talking about anymore. And I think the GDP numbers in places like Taiwan are very much that way these days. But I mean, in Southeast Asia too, it's been a big beneficiary of the strong trend in global trade. And I have to say, I got this one wrong multiple times in the past couple of years. I mean, after Liberation Day, and then again, after Trump started his war in Iran, I thought global growth would take more of a hit, and it really hasn't turned out that way, to my surprise. And I mean, I think to explain why that happened, it has to be AI, right? I mean, we could talk about flexibility in energy markets, and I know we'll get to that a bit later, but this AI story has been absolutely relentless. As it rolls on further, more countries are getting pulled in. And obviously it started with the US hyperscalers, but we're now seeing, I think the Chinese hyperscalers are on track to spend over $100 billion US dollars this year. And that's just in China. This CapEx spending is spilling over to basically anyone that touches a manufacturing supply chain anywhere in the world. And it's also broadening beyond AI, right? It's all the stuff we need to build new energy infrastructure, both to power data centers and, because of the Iran war, a bunch of countries are looking at, how do I shore up my energy resilience? How do I get a stronger grid? How do I make sure I'm less exposed to another Hormuz shock in the future? And all that takes equipment, and equipment is made in Asia, 50% of global manufacturing output. So I think it's all kind of green lines pointing up and to the right for Asia these days. At least that's from where I sit. I wonder if you disagree with any of that.
No, absolutely. I'll give you my 2 cents in a second, but first I want to ask you this one question, which is when you look at the region, Ethan, do you feel that it's a bit unbalanced growth, that it's all about the electronics exporters basically having Christmas times 10, but if you're in the pharma business or in the textile business, things are not that great? Or is it really the case that the tide is lifting all the boats?
I think it's more the former than the latter. It's more K-shaped than non-K-shaped. But I want to give a quick mention of some of this stuff is broadening out. I mean, we're seeing wage growth in Taiwan pick up, and we're seeing demand pick up in Korea. I mean, and these were the most dramatic K-shaped stories where you had one company not one, but a small number of companies in Taiwan and just a handful in Korea, really picking up most of the growth. There is some spillover effect, right? As we would expect, like if all the chip engineers at SK Hynix and Samsung Electronics are getting mega bonuses, I mean, that's got to go into the property markets and the luxury goods markets, and that spills over to whoever's selling those goods. And there should be some multiplier effect. But I mean, it's very much going to people at the top. And to the extent it trickles down, we're seeing some evidence of that. But I think, generally, particularly in, semiconductors, that's a supply chain pretty insulated from the rest of the economy. The average person is not hoarding chips, right? I mean, you might have one in your computer or have one in your phone, but you don't have a personal data center, right? And that's where a lot of this stuff is going.
It seems to me that there is a feel good factor. I think you feel good
Yeah.
when you read good news in the newspaper. So even if your company, your sector is not at the top of the pecking order, it feels good to be part of a dynamic part of your history when big companies are making a lot of money. So I think that's one. Second is that there is a wealth effect to the extent that people
Yeah.
own
Yeah.
some stocks or have some exposure. The markets rally help people substantially. Then it also seems to me that despite the war and the tariff and all that kind of stuff, whether it is the pharma cycle or the cycle for energy that you just touched upon, or even just apparel and furniture and toys, global consumption has been fairly resilient. I suppose we have
Hmm.
the ever resilient American consumers to thank for that. Asia still trades
Hmm.
a lot with the US, but by and large, I don't see any material dip in demand for consumer goods that are made in Asia, say from Europe or Middle East or elsewhere. So I agree that the biggest dynamic, extraordinary jaw-dropping stuff is at the top end of the electronics value-added spectrum. But the rest of the economy, it's not that bad that it's like people losing money on one side and people making a lot of money on their side. Everybody's making money in varying degrees, it seems like.
Yeah, no, I would tend to agree with that, and I mean, I think it's worth saying like the manufacturing cycle is not what it used to be. I mean, economies these days have a smaller and smaller share of manufacturing as a share of total employment. Services and consumption are more important in most developed economies and a number of developing economies than they ever have been. And I think what that does is dampen the swings in the business cycle. Like services consumption is pretty consistent for the most part. People need the roughly, same amount of haircuts and same amount of services that they usually need. And I think part of the case in the U.S. like after the pandemic for a hard landing, right? That after the COVID stimulus and the inflation wave, that there would be a recession was that there was this this sort of big shift from goods to services, and the U.S. economy kind of needed a reset, but it really didn't end up happening. There was even after these dramatic post-COVID shifts, people just kept on spending, even as they were telling pollsters that they absolutely hate the economy, that they feel terrible. And again, I think it's because people have like roughly the amounts of like hair dryers and washing machines that they need, and like all the other stuff in the U.S. it's like 70%, but even in a lot of economies here, it's still a significant proportion. That stuff is like relatively resilient to the cycle, unless there's something absolutely catastrophic like COVID or like 2008.
Yeah, absolutely. So since you're talking about resilience, and we did touch upon this earlier, so the Iran war was supposed to be, hitting this region really, really hard. We kept on talking about in April and May that how 20% of refined energy products around the world and a very large chunk of crude products, oil and gas, are coming through the Strait of Hormuz, and Asia being the chief importer of that product. So it might work out for the Americans. They might see some higher prices, but not supply shortage, and they might even help the Europeans out. But Asia is in big trouble. Well, it hasn't really turned out that way.
Yeah.
We have, airlines not really cutting back on their flights, even if prices have gone up. People seem to be filling airlines and traveling around the world, and we haven't seen any 1970s style pictures of people standing in long lines to get gas. I shouldn't sort of paint a broad brush. I do know there are places there have been shortages, but overall, it seemed like it has surprised on the upside the overall resilience of the region. So let's talk about that, Ethan. What gives?
Man, what what gives indeed? It's a very good question, and was a subject of a much commented upon leader in the Economist called "We Was Wrong," when we apologized for calling the oil price massively incorrectly. Like when we were at like $120 on a barrel, we thought it would go to 200. Since fallen back to 60, and now it's back at 90. But I mean, this energy cycle has thrown a lot of people for a loop, and I think we're no exception. What's happened? So, I mean, I think China is the big story here, right? That demand flexibility on the Chinese side served as a damper for the global supply demand balance. And I mean, I think that happened in a couple ways. One is just that their stockpile may have been a lot bigger than we thought. I mean, China's not a country that discloses a lot of granular information on their energy supplies, and so when we saw Chinese imports of crude drop as drastically as they did, this may have been one of the factors behind it. I mean, another is that intense investments China has made in electrification, I think also created another demand buffer, right? So you had pretty clear economic incentives and the infrastructure set up for consumers to be able to pretty rapidly switch to EVs, as necessary. This created, additional demand, demand flexibility. I think Jeff Curry over at the Carlyle Group estimated it was the equivalent of like about 1 million barrels a day, if memory serves correctly. So I mean, this Chinese demand flexibility, I think, has been quite big part of the story there. But the other part is that, I mean, Trump did back off eventually, and the sort of market view, which at the time I was skeptical of, but I think that proved wrong. What was that this would be too painful for Trump. Cost of living is the number one issue in the U.S. by an absolute mile, and he'd get a couple months in, and he'd have to relent and give some relief on gas prices. And now we're in this sort of weird situation where he's kind of relented, but also kind of not. And oil is not at 120, but it's not also back at neither is it back at 60. So I think we've ended up somewhere a little bit more ambiguous today. But at least for a while, Trump genuinely did relent when the memorandum of understanding was signed. So I think you can kind of explain it in those two ways, but I have to say, I mean, maybe you were more correct on this, but I've been quite surprised by the way a lot of this has played out in the past few months.
Yeah, so Ethan, I draw a parallel between the 2022 Ukraine war and the 2026 Iran war. In
Yeah.
both cases, I think we have seen that the system, at least at the crude level, actually can produce a lot of stuff at pretty short notice and balance out wherever the supply shortages are. So in 2022, when Europe decided to decouple away from Russian energy supply, there was enough gas in the Middle East and enough crude oil among the U.S. shale producers to take care of Europe. And similarly, right now, I have, for example, seen stories of regional refineries which were very much reliant on importing crude from the Middle East, switched to shale crude oil and started refining them. Probably not the best quality crude to make the refined products. Maybe that create some margin pressure on them, but it's not a sudden stop in supply for them. So maybe that could be one. But I fully agree with you, Ethan, that China's demand management is perhaps the biggest story more than anything else.
Yeah.
But just two sort of personal anecdotes. One is I bought an EV last year, and now, like, for the same amount of range, Ethan, I spend about a third in my transportation cost, because although electricity and petrol both are market rates in Singapore, it just costs less to charge a car than with electricity than fill it with gasoline. So my resiliency has gone up. My pocketbook is affected less by this shock than it would have been a few years ago when I drove an ICE car. So I think that is true for just about everybody who drives an EV in the region, unless you're in some country where they're very, very inefficient electricity supply. And the second is this ability of refineries in this part of the world to start beginning to handle some of the supply shortage that is coming from the Middle East. So if you think about Singapore's refineries, absolutely consequential in the region, right? When you look at countries like Australia, New Zealand, Indonesia, depend very much on Singapore and refineries. So as long as they can get the crude going, these refineries will keep supplying to those countries. China, as you and I know, a few weeks ago decided to allow for their refineries to get back into the business of exporting refined products. Korean refiners are prolific. So maybe the system is capable of handling some of the shock, not all of it.
No, I think that's right. I mean, I think I remember right after we chatted right after you had gotten the EV, and you seemed pretty starstruck by all the new features, and you could park itself, and you get an app on your phone, all this fancy stuff. I mean, these are very competitive cars that are that are attractive. I mean, people are not driving these because they're do-gooders. They're driving them because they're great. They're great cars. But I think I'd make a broader point too, which is that we've now seen really time and time again how resilient global markets and the global economy and supply chains are to shocks of historic proportions. So, I mean, COVID, for all the discussion of supply chains breaking, supply chains ended up being pretty resilient. Like there were bottlenecks for sure. I mean, chips being perhaps the biggest one, but those port backlogs in LA, in Ningbo, those did get resolved. Like there were some toilet paper shortages, but broadly goods stayed on shelves and the global economy found a way to chug along. We saw it again after Ukraine. I mean, there was an energy crunch in Europe, but they did find new sources of supply, even at higher cost. We've seen it again now with the Iran war. And this just seems to be a recurring pattern that we may underestimate the global economy's ability to flex to these kind of supply shocks, which are becoming, I mean, undoubtedly more frequent and more severe. But I mean, with instant communications, with the kind of learning by doing of adjusting to big shocks, I think traders and companies are pretty limber and they'll work with whatever conditions come their way. This is not to downplay the fact that this stuff really does affect people. I mean, particularly in the developing world, this energy crunch has been pretty nasty to farmers that can't get fertilizer because they're priced out, or governments that are having to cut AC in the office, God forbid, in the tropics. That's punishment enough. This is not like to be taken lightly, but I think I've been impressed by how flexible the global economy is to these sort of persistent shocks, and God knows it's not going to be the last one.
No, it won't be, but I think the data is impressive. So now we are in year 6.5 since the pandemic of 2020, and we've had two big wars, the trade war intensification and the pandemic itself. Take these four massive shocks, and there have been some financial market instability to throw in between. Ethan, global growth has not fallen below 3%.
Yeah,
through this entire episodes or episodic shocks, 3.5, 3.8. Now, I think the IMF's forecast for 2026 is 3. I think they'll be wrong. It'll be higher than 3, given the amount of data that we have for the first half of this year.
Yeah, totally. And I mean, you see, even with Trump's tariffs, both beginning in 2018 and then with Liberation Day, connector economies sprung up pretty rapidly. And this has now become, I think, a bugbear of Peter Navarro, Trump's trade advisor. But, supply chains adapted. Chinese companies shifted production to third countries. I mean, in many cases, I think legally, not skirting U.S. tariff rules, but actually just changing the production process to qualify for the lower tariffs in a Malaysia or in a Vietnam. And that's to say, I mean, give people an incentive and they will respond.
Let's put a pin on Peter Navarro. I want to come back to that later. But we've talked a lot about resiliency, but I'm sure some countries are more resilient than others. So let's do a little bit of a stock taking of the region. Which countries have come across to you most impressive in dealing with these shocks, and which have struggled the most?
Yeah, I mean, I think what stands out in terms of countries with impressive responses is China on the one hand and Singapore on the other. I mean, China has been preparing for a shock, just like the one we've just had in the Strait of Hormuz, for years and years and years. And I think the party has long understood that energy is a real weakness of the country given its geological endowments. Their stockpiling strategy has been very effective. I mean, they had, some capacity was shuttered, I think, particularly in, petrochemicals. There were some difficulties, but broadly speaking, the Chinese economy chugged along. And that's important at a macroeconomic level today, more than it was in the past, because the Chinese economy, it's no longer about urbanization, about real estate, about infrastructure. It's about manufacturing and it's about exports. This is the new engine. And so it really matters to keep your factories running. You need energy. And they managed to keep, again, there was some dip in the activity numbers, but broadly speaking, exports continued hitting highs. Industrial production took a small hit, but it kept on chugging along. I've been pretty impressed by China's strategy here. And I think to the degree that we have a playbook for dealing with supply shocks, stockpiling really helps. Like this happened in Japan and Korea too, where they had hundreds of days of crude supply that really came in handy during the shock. Obviously, the gas picture is a bit more difficult for Japan and Korea. But on the less impressive side, I mean, I think Southeast Asian and South Asian developing countries have had a lot of trouble. And, in a way, this is, you could call it, demand flexibility that, cooking oil is getting rationed in Pakistan and India and Indonesia. But, I mean, these are some of the poorest people in the world who are losing access to basic necessities. And, if there's any function of government, it's to shield precisely those people in precisely these global economic conditions. And I think, in too many cases, governments failed to do that. Obviously, that reflects financial constraints. But I think you look at a country like Indonesia, which has been kind of implementing precisely the wrong policy mix, to go into the shock. I mean, we're talking about a country that used to be part of OPEC, that's now a net energy importer. They were caught pretty unawares, and a lot of their budgeting assumptions did not keep up with global economic conditions. Now they've been, I think, helped a bit by Trump's relenting on this war. That we'll see how it plays out the rest of the year. But I saw too much policy rigidity in countries like Indonesia. For a place like the Philippines, I mean, I think they did adjust, a bit more quickly and were more flexible. But if you're a poor country, it's just quite difficult to weather these shocks.
Actually, those are very interesting case studies in compare contrast. Philippines, to its credit, that in the past 2 decades has shown amenability toward passing on global energy price shocks to its population, and hence, when we look at the inflation chart of the region, it looks like they're really badly off because their inflation has shot through the roof. But it's because they're not letting it to blow up their budget and blow up their subsidy bills, which is what the Indonesians and the Indians have chosen to do. So even though inflation doesn't look bad, the bill is coming due, and that is showing up on their balance of payment pressure, on reserves, on FX, where in the case of Philippines, it's not a great picture, but they've just decided to take the bitter pill early on.
Yeah, no, it's very true, and I think this crisis has showed why energy subsidies are a problem, which is that they are expensive in the best of times, and they become even more expensive in the worst of times, precisely when your fiscal space is shrinking. It just compounds that pressure. So I think we saw this pretty vividly in Indonesia, where like concerns about the fiscal position, which already been quite acute, if you look past the energy subsidies just to propose programs like free school meals and agricultural cooperatives, those were already big enough. Then you double the subsidy bill for the year, and you're suddenly talking about a real fiscal credibility issue. The issue is that energy subsidies sign you up to absorb those global economic impacts, and there is a just physical reality of if there aren't enough barrels to go around for a period of time, you need to do some demand rationing. It's not going to be possible to completely insulate households. I mean, what you want to do, and the IMF has been, banging this drum for a million years now, is protect the most vulnerable, pass on the costs of higher energy in a sort of progressive way, so that the poor don't pay much, the working class pays a little bit, the middle class pays a bit more, the upper class pays full freight. Obviously, the politics extremely treacherous. Jokowi in Indonesia in 2023, after the Ukraine war shock, faced protests when he rolled back Indonesia's fuel subsidies, as he felt he inevitably had to. And I think, again, like I have sympathy for the politics here, but that's a good case for just not doing this stuff in the first place.
Right, and I think the Philippines example also showed that we probably underestimate the population's ability to take the shock. They know what's going on in the world, so they're not going to necessarily blame the government. It's a common shock. Whereas if you do make it very country specific, and then you can never ever get out of that morass, because then people expect the subsidy. So Ethan, my joke in this context is that for Philippines fishermen, doesn't really matter what the domestic price in the Philippines is. They can always come in the waters and get them friends from Malaysia and Indonesia to give them lots of subsidized oil.
Yeah, or the folks that go to Batam to get the subsidized Indonesia petrol, fill up their boats or whatever. Exactly. It creates all these arbitrage opportunities.
Yes, and it doesn't help the country's original intention of protecting the poor, which just becomes a system-wide subsidy. Yeah. Ethan, you mentioned Peter Navarro, and we have actually managed to have this long conversation without mentioning Trump a lot. But I think it's time we do. So, Asia is so trade-oriented and so Western-facing. So the U.S. policy on trade or tech or security, keeps commanding headlines. We're having this conversation on the 20th of August. This week has been all about Trump's rather, incendiary remarks on Korea and how he's sort of, telling the U.S. military to scale back its operations there. We can, of course, spend 3 hours discussing this issue, but let's do step by step. Trade. Where do we stand month 16, or is it month 18 since reciprocal tariffs were announced?
Yeah, I'm afraid to say I don't know that we have very much more clarity than we did in the months after Liberation Day. Particularly on how the implementation is going to work, if countries are going to face transshipment tariffs, that remains, I think, very unclear. And so, with respect to Navarro, he just put out this paper last week on the Great Transshipment Scam, by which he means, if you create a big tariff differential between China and the rest of the world, then supply chains are going to adjust, and that's ostensibly a scam. But one way to interpret that, as I know our mutual friend Deborah Elms has, is as sort of a salvo, a warning shot that these transshipment tariffs are coming, the transshipment crackdown is coming. I'll see it when I believe it. I think this is still a White House where there are people concerned about affordability. and tariffs, if you apply them in a broad-based way, and you don't allow for these for third countries to process, Chinese components and assemble them and ship them to the U.S., that's just going to raise prices across the board on all kinds of goods that Americans consume. So, we'll have to see what's coming on that front. I think the trade policy continues to be characterized by incoherence, by volatility, and I think this just reflects that there are fundamental differences within the administration. There are people that are domestic focused that care about the midterms and care about how Trump is perceived on issues like cost. There are people who are totally focused on China and strategic competition. There are people like Navarro who are extremely China hawkish, like on this. And I think if he were in charge, there would be zero Chinese content allowed in any goods anywhere in the world into the U.S. So I think you take these different, and then of course you have the tech faction, which has a degree of China skepticism, but I think understands if you're going to build all these data centers in the U.S., by God, you're going to need some components from China. I mean, the electronic sector runs through Asia, and you can't just avoid China adjacency. So I expect more incoherence, frankly, in the coming years, not less, because these fundamental divides have to be adjudicated ultimately by the president. The buck stops with the president. And there is not a U.S. president who is willing or able to adjudicate these differences.
No, definitely not. I think some of the tariffs post-Trump will stay because once these things go up, it's really, really hard to bring them down. But even in terms of some tariffs that were challenged in courts, and then the Supreme Court agreed and shot them down, and now we have additional legal challenges, particularly on the Section 301 and the labor practices. What's your sense? I mean, there are a whole bunch of states who have sued the Trump administration on that platform as well. Will that also get shut down?
I mean, listen, I think there is no shortage of legal authorities in the U.S. to implement tariffs. I have a lot of confidence that Trump's clever lawyers can continue to find ways to re-erect the tariff wall. So it's true, they faced some legal setbacks, but I think what they're counting on is that they move much faster than the legal system can. I mean, how long did it take to strike down the IEEPA tariffs? Like over a year. And so I think they'll be able to continue to find legal authorities for the remainder of Trump's term. These Section 301 tariffs are thought to rest on stronger legal authority than previous tariffs had. We'll see. I'm not deep enough in the law on this to have a strong view on kind of what will and won't stand up in court. But I mean, it's worth remembering, like a lot of the China tariffs, which have had, I think, have been the most important tariffs and have created this tariff differential that's reshaped global trade in the past, half decade or so. Those were erected under Trump 1, under legitimate tariff authority. They were kept in the Biden administration, and they're still on today. So even though some of the most extreme stuff, like the 100% plus tariffs, have been walked back, and the kind of broad-based IEEPA tariffs have been walked back, the president has ways of doing tariffs. And Congress seems set to give him even more authority vis-a-vis Russia and tariffs related to Russia and Ukraine. So I think we're just in a tariff moments in American politics, and there's a lot of sympathy for these policies on both the right and left of American politics. And I think you're right, the tax revenue is part of that. Now, we should say, this is not revenue coming for free. Like, you pay out of the aggregate economy for this tariff revenue. But from the perspective of the US government, it appears as a revenue item on your books. So it looks to them like all upside, even if you're paying in terms of reduced competitiveness of sheltered importers, even if you're paying in terms of reduced efficiency of global trade. This all shows up in your aggregate GDP numbers, but no one is, doing an accounting of that is kind of an abstract exercise, and literal tariff revenue flowing into the coffers of the Treasury, that's completely concrete.
Yeah, absolutely, Ethan. And I may have shared this anecdote with you right after the reciprocal tariffs were announced. I have a friend who owns a garments factory in Bangladesh. And I asked him that how is he going to deal with it, because garments factory owners run on very thin margin. An 18-20% tariff would wipe him out. And Walmart was his biggest buyer. And he told me that, it's a three-step process. Walmart and I have agreed to burden share for about 12 months. So I will take some of the hit. They'll take some of the hit. But they have promised me that over the next 12 months, they will sooner or later pass it on to the U.S. consumers. And then a year from now, I'll be whole. And I went back to my friend recently because it's been more than a year. And he said, yep, that's exactly what's happened. They did some burden sharing. And at that point, the margins of Walmart and him were affected. And now it's back to the average American Joe. They are paying for the higher cost.
Yeah, I mean, and it's really very simple, right? Tariffs are a tax. You tax something, the price of it goes up. I mean, there might be some complexity in terms of who pays how much at what time, but I mean, those are really questions of transition. I mean, ultimately, these are paid by the consumer because tariffs are a consumption tax. It's a tax on things people import to the U.S. to buy. At the end of the day, so it's not surprising, and the attempts to pedifog the issue of who pays tariffs, I just don't think Americans are buying it. You look at polling both on general cost of living and on tariffs themselves. I think people understand this. It's not particularly complicated.
But it is interesting that despite the fact that we have a big, midterm election coming up, that
Hmm.
nobody on the left or right has linked tariff with cost of living. They make general criticisms of Trump on war and, making allies into enemies and that sort of stuff. But nobody says that if I come to power, if I have power, I will reduce tariff. That is like
Hmm.
seems to be not a go area for anybody.
I think the Democrats have tried, maybe not effectively. I mean, if I remember correctly, Harris was talking about the Trump sales tax hike for a while, but no, I think broadly you're right, and it's partially because I mean Democrats are not totally against these tariffs,
Mm.
right? Biden kept on the ones on China, and I think there is you can imagine sort of a Democrat version of like industrial policy with tariffs. I think folks on the left talk about well, it's tariffs aren't the issue; it's the way he's done the tariffs. So I mean again, this is a very statist period in American history, and I think tariffs are sort of part of that general a push toward more managed trade. And I really don't think maybe some of them will go away if there's a Democrat elected in 2028, but I think many of these will stay on both because of the revenue and because the politics of getting rid of them are a lot harder than the politics of just leaving them on, right? People have already swallowed those costs. But I think I'm not a political advisor, thank God. But if I were, I think I'd be hammering gas prices, probably not necessarily tariffs.
Yeah, and that's definitely an easier sell. Statist and protectionist. All right,
Yeah.
let's leave trade aside for a second and talk a little bit about tech. Uh, there are hyperscalers who are lobbying Washington to ban open source models from China, and then there are others in America, like Ubers of the world, are saying, no, 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 we use those models and they're very cheap, and we'd like to continue using them. So you have one set of debate in the US, and then there's this other sort of debate, which is that the Americans are telling everybody around the world, don't use Chinese models because that's not a good thing to do if you're going to be friends with us. So how will Asia balance all this stuff?
Man, it's I think from an Asian perspective, I think there's just less hostility to the Chinese models, right? I mean, they're much cheaper, widely available. I mean, in most parts of Asia, all parts of Asia, if I'm not mistaken, there really aren't American style leading model makers to easily supplant the American ones that are quite pricey and give an obvious alternative. I mean, there are some exceptions, like Japan has companies like Sakana AI, and there's a few here and there. But broadly speaking, it's the U.S. or it's China on this issue, and the Chinese are offering low cost, open source, not quite cutting edge, but like not too far behind it. And I think that's going to be very attractive. Now, then again, I mean, we're in such an early stage of adoption. It's worth really stressing that like people do not have the tokenomics figured out on this. Like I just I'm a bit of a noob on this, but I racked up a $25 tokens bill the other day trying to file my expenses with Claude, which kind of defeats the purpose, I think. But I think we're such a long way from equilibrium that I think actually there's plenty to go around in terms of demand right now. But if the U.S. began cracking down aggressively, like in a global way, on the availability of Chinese open source models, I think you'd see some backlash on that. I mean, other countries are not America, where you have the homegrown alternatives to easily substitute toward. But I think honestly more interesting to me than the software, which is again so nascent and the government's just trailing the private sector massively here, is the hardware. I mean, this continues to be a massive area of contestation. And the U.S. is getting, I think, increasingly aggressive on this under the hood, despite the Busan pause, earlier this year between the U.S. and China. I've been interested in the FCC, the U.S. communications regulator, has these proposed rules which are going to limit Chinese components for firms on the entity list, which include companies like Huawei and ZTE, from getting put into any U.S. electronics products, almost any U.S. consumer electronics. So in order to get FCC certification, you're going to have to limit the number of Chinese components. And Brendan Carr, the chair of the FCC, calls this the component loophole. That is a much more aggressive posture than has happened in the past, right? But before, it's just you can't buy from these entity list companies. Now it's you have to actually evict them from your supply chain, or you're not going to be able to sell to U.S. consumers. And I think, again, as I referred to earlier, there are factions of the government in the U.S. that are much more, militant on being anti-China. And you see, we have a story coming out in future weeks on the FCC sort of as the premier national security anti-China agency within the U.S. So I've been watching that with some interest. I mean, there continues to be issues around export controls, and I think one test case will be, will the administration let Apple get memory from China, from CXMT and YMTC, the new kind of rising Chinese memory companies?
Well, if they don't buy it, the rest of the world will. I guess that's where I'm coming from, Ethan. I mean, the Americans can choose what to buy and what to not to buy, and we've already seen, at least through 2025, China's exports to the U.S. fall a lot. But then the Navarros of the world say, "Oh well, we have lots of made in somewhere else product, which is essentially a Chinese product still coming, and now we got to do like a guacamole kind of thing and go after those guys." So that's all good. I suppose the world that I'm thinking about is the non-U.S. world.
Mhm.
Would the U.S. try to influence Singapore's decision in terms of whether a Singaporean firm, if they want to do any business with the U.S., can they have any Chinese tech on their platform, or would they be considered a security risk just because they're using certain inference models for China or some 5G, 6G equipment from China? How far will the U.S. go in that regard?
I wish I knew. I mean, again, I risk repeating myself. It's a very incoherent policy. I think it depends which segment you look at. There are sort of different policy impulses. But under Trump 1, there was an attempt to they call this the Secure Cloud Initiative, to evict Chinese telecommunications equipment from third countries' infrastructure. They don't want Huawei or others. They want to replace them with Nokia and Ericsson. I think that fell through. It was a bit too little, too late. The Western offerings weren't as competitive as like the Huawei offerings. And Asian countries just didn't see Huawei as much of a threat as the U.S. did. And I think within the U.S. there's an understanding that they sort of lost the 5G battle. Maybe they'll try it again with 6G if and when that comes our way. I have to say I don't even know what 6G is, whether it's any better than 5G.
Something much faster.
5G but faster. Yeah, we'll see. But I think the U.S. faces fundamental trade-offs here, and there are different impulses, and they're not being adjudicated, and governments are doing their best to adjust. I mean, where it is clear is export controls. The U.S. is concerned about chip smuggling. The U.S. is really concerned about extreme ultraviolet lithography machines making their way into China. There was a big controversy about whether kind of ex-ASML engineers, ended up getting rehired by Chinese companies and having trade secrets leaked. And are some of these machines or their parts either for EUV machines or for the previous generation deep ultraviolet machines making their way to China through Malaysia or through Singapore? I think that will continue to be a place of pressure that the U.S. administration puts on Southeast Asia. But on the rest of it, I think it still remains. Tell me if you have a better sense, but I really don't.
Yeah, I was talking to the South Asia representative of a California-based global router maker. If I name the name, everybody will know which company I'm talking about. It starts with a C. And the sales rep was basically telling me that their sales in all of South Asia has plummeted, with the exception of India, where there's still decent sales. But whether they're customers in Bangladesh or Sri Lanka or Pakistan, they're very happy to buy communications equipment from Huawei. They don't have national security concerns. Right. They like the fact that the software is open source, which makes it cheaper for them to maintain. They don't have to deal with periodic fee-paying updates all the time. And they find the customer service very reliable. And as a result, this California-based company is losing a lot of business. So it goes back to that point that if the Chinese are going to compete with open source software platforms and be very confident in their ability to keep on upgrading, and therefore they don't want to charge massive IP charges around whatever tech they're selling now, it's going to be extremely hard for American companies, which basically operate with the IP rent extraction model. I come up with an innovation, and for a decade, I will extract significant amount of innovators' rent out of that. If you have another innovator who doesn't really care about that, your model sort of breaks down.
Yeah, yeah. I think that's right. And given the uncertainty, both the uncertainty over U.S. policy, but also, I mean, the general direction of travel toward this stuff is becoming an increasing space of contestation. I mean, the sovereign AI, sovereign cloud, just sovereign technological infrastructure, I think, is the way things are going, right? And this is not just in Asia. This is also, I mean, notably in Europe. I think they're very concerned that this is a lever the U.S. has to pull. And as the U.S. gets more aggressive toward Europe, Europe needs American cloud providers. The U.S. needs American tech services. And this is a choke point that the U.S. can weaponize against its own allies. In these days, you have to put allies in quotation marks, but I think in the next 5 or 10 years, there's going to be a huge push and a lot of money behind just upgrading your own technological infrastructure, making sure you have resilience from, I mean, Chinese coercion, yes, but also American coercion. Everyone's going to want something of their own. There will be areas where it's harder to build. Again, I don't think every country is going to have a frontier lab, but every country probably could have a cloud services provider or data centers or something to that effect, or certain types of enterprise software. I think could probably be pretty easily made at home if there's government money behind it. So, I mean, I think that's the direction of travel globally, not just in Asia, but I mean, certainly in this region too.
Okay, from tech security to broad-based national security, we're already seeing that the Americans don't want to spend as much money they have been spending in Europe, so they're asking them to either foot the bill or we're out. Korea got somewhat of a similar, rather disturbingly phrased message in the guise of friendship with Kim Jong-un earlier this week. And then we have a bunch of other countries in Asia, which are largely very much aligned with the U.S. defense framework, but again, can't really see the U.S. as reliable a partner as they saw in the past. What's happening with defense spending and defense planning in the region?
Well, it's going up, to put it very simply. It's going up again everywhere. But I think Asia it's coming off a very low base in a lot of countries, right? Notably in Japan, where they've now legalized arm exports. They're aiming for 2% of GDP, which I mean, isn't that high by global standards, but for Japan, I mean, that is a serious increase in expenditure. I think in tech, in energy, in AI, and in defense, we're seeing basically versions of the same trend, which is everyone's going to need to spend a lot more money on hardware to give yourself sovereignty, autonomy, and resilience from outside coercion. And so, I think the Asian story is a bit segmented, right? You have like, U.S. allies like Japan, Korea, Taiwan that are having to, invest more in this and probably should have done more anyway, because the U.S. is pulling back. How serious Trump is about cutting support to Korea, hard to say. This could be about dissatisfaction on the $350 billion investment deal that Korea signed with the U.S. and that America feels it's not been kind of living up to its word here. I think Korea probably can mitigate that. They have enough companies that are invested in the U.S. to like create a plausible sounding investment package probably and put some government money behind it like the Japanese have. But the broad trend's clear. The U.S. is pulling back from Asia. How much, how much they come to help in a crisis, how much they're pulling back, that remains to be seen. But in East Asia, for sure, spending is going to have to go up. Then again, in Southeast Asia, I mean, Chinese provocations in the South China Sea are on the rise. I mean, they've recently completed construction on a facility in a key island of the South China Sea. The Philippines is on high alert. There are, continued disputes between, fishermen and sailors. I don't think this is going to go away. And, I don't want to bet on war because this is grim stuff. And like, I do think deterrence is, it's one of the, we have a tendency to underrate how effective it can be. I think you can effectively deter wars, but to have deterrence, you need like a strong, credible military. And so, what I'm seeing across the region is just spending is going up.
Again, speaking of grim stuff, so one thing that I always say is that unlike the 60s and 70s, when every Asian army seemed to be either involved in a geopolitical conflict or quelling domestic communist insurgencies. Now we've had this peace dividend for the last 30, 40 years.
Yeah.
Our armies just don't have any practice, unlike the counterparts in the US who fight a war every 5, 7 years.
Yeah.
Whether
Yeah.
this Chinese army or the Japanese army, nobody has fought a war here in multiple generations.
Yeah.
So yes, they will probably spend more money, but to what extent that creates insurance or risk of accident, that sort of keeps me awake a bit.
Yeah.
Ethan, so I'm glad that you drew that thread, that whether it's trade or tech or national security, the direction is that, to deal with all this uncertainty and changing of the rules of the game, you got to spend money. Today is not the day where we talk about the secular rise in global yield. I'm going to bring you back another day and talk about the bond market crisis that could be brewing. But I guess that's the conclusion. Everybody will spend
Yeah.
more money and more public debt will get issued.
Totally.
And I want to pivot to China. We know that China has a pretty dynamic manufacturing sector, so much so that it sort of worries the world about excess capacity. And we also know that the domestic demand has been pretty weak. We got some rather bleak data in the course of this week, whether it is retail sales or youth unemployment. So give me a sense of how you characterize China's economy right now.
Yeah. I mean, it's very two-track, and I'm obviously not far from the first person to notice this about China. But the domestic demand story, I think, can be thought of as the obverse of the strong exports story. Now, there's been a very interesting debate of late. It's been happening a lot in the pages of my publication in The Economist about the currency, the weak renminbi, which on I think basically any metric you can look at real effective exchange rates, you can look at the Big Mac index, you can look at fundamental equilibrium indices. Whatever it is, China's currency is probably undervalued. One interesting question that we've been hashing out on our pages is this symptom or cause of this sort of two-track economy and the domestic weakness in China? And I mean, my view on this is it is both, but it is more symptom than it is cause. And I'd be really interested in your views here. But I mean, my sense of this is China had a growth model that was dependent on, wide-scale infrastructure and real estate spending. They pulled the plug on the real estate portion in 2021 with the 3 red lines restrictions. And since then, they've been looking for a new growth engine. They've found this manufacturing model, but their way of doing manufacturing growth is very driven by capacity expansion and not necessarily by kind of full utilization of their domestic resources. I mean, there was recently a fascinating paper in the National Bureau of Economic Research called Monetary Policy in Mandarin Capitalism. And it was all about how, like, unlike in the West, where we think about monetary policy as a demand management tool, in China, actually, monetary policy is supply management. It's credit to build factories and the like. They have an entire system oriented toward production first. And so I think what you end up with is just a very simple supply-demand imbalance in a way, and that shows up in the deflation problem that they continue to have despite the rise in the producer price index, and sort of the CSI 300 consumer index is way behind the benchmark index and all these other indications. Retail sales are weak, et cetera, et cetera. I think they will need to stimulate to turn any of this around. And I think this is the fundamental cause of the both strong exports and the fact that strong exports have diverged from imports that are not growing very quickly at all. It's a structural issue. It has to do with the Chinese economic model. And yes, the currency on the margin, I do think they do manage the currency, and they could manage it up if they wanted to. But I don't think this would actually solve the problem because it's much more deeply seated than just the currency alone. But I'm interested in your view here.
Yeah, Ethan, it's fascinating that you talked about that in the context of the currency. So I think that we can agree that the currency is likely undervalued, but also agree that if they let the currency go today, it actually might depreciate because there's a lot of capital sitting in China that wants to leave China. So it's not going to be the panacea that the Americans hope that, we force the Chinese to let the currency go. Currency appreciates and it becomes like the Plaza Accord type thing, and the Chinese feel very rich the way the Japanese felt, and they go around the world buying stuff, and that sort of addresses the thing. First of all, I think the Chinese will never do that because they are haunted by what happened to Japan after the Plaza Accord and that appreciation and the bubble that it created. So I don't think they'll ever allow that to happen. Secondly, I think, like I said earlier, that if you were to actually float the currency, it might actually weaken as opposed to strengthen. So even on the excess capacity and the sort of production-driven model where keeping capacity is an artifact of the Chinese economy, I think it's an artifact of the global economy. I think we go through feast and famine for all sorts of manufacturing cycles. So there will be times when we'll have a lot of cars in this world because there's demand for car and all the manufacturers want to build up car production. We've had this with chip cycles where there'll be time when there's a shortage of chips and there'll be time there's such a glut of chips that it falls. We have this with energy all the time, right? Energy prices are so volatile. When energy demand doesn't move that much, it's the producer. Sometimes they just go crazy and just keep on pumping because of their own needs. And then we have a lot of oil and oil glut and prices fall. So I think that the way global capitalism works, I don't think it's that super efficient. It does cause the boom bust cycles, feast and famine in production. And China, in my view, is a bit of a microcosm, although micro is not the right word given how large China is. But you get my drift, right? That when you have an economy that is growing and you have a bunch of provincial governors who are aspiring to have their province growing faster than other provinces, it's like almost by design, they would want to pump production and get some stuff going. But then again, I have to give the Chinese credit in this regard. They allow for creative destruction. I see this as a big differentiating factor between Japan in the 80s and China now.
Hmm.
How do we characterize Japan after the big bubble burst, which is that zombification of the economy? They didn't let companies go out of business. I think the Chinese have no problems letting people go bankrupt and companies go out of business and then let the survivors take the spoils.
Yeah, so a lot there, but let me start on the currency. I'm not sure actually what would happen if they let it float, to be honest. But I think if the PBOC wanted to, they could actively manage up the currency. I mean, they could use. They have a lot of foreign exchange reserves. There are a lot of offshore funds held by Chinese exporters in foreign currency that could be leaned on to repatriate those funds to push up the currency. I think the PBOC has a lot of control with the fix that it sets every day. On the renminbi. I think they have tools to push it up if they wanted to, if they decided this is a policy lever that they want to pull. But I think you and I are in agreement that this is not going to solve the sort of structural issues with the economy. I mean, on excess capacity. I just zooming out a little bit. I think there was a great piece by Karthik Senkaran at the Quincy Institute where he pointed out that you could think of the U.S. and China as sort of opposing systems. China has quote unquote overproduction and America has quote unquote overconsumption. And he pointed out that overconsumption in the US comes kind of chiefly from the healthcare sector, which as everyone knows is like wildly inefficient. Anyone who's ever had an insurance plan, I actually used to briefly intern at a health insurer, and let me tell you, not the most efficiently run company. America spends like 16-17% of GDP on healthcare. Right. It's a tremendous amount of middlemen. The price signals are all screwed up. It's shot through with moral hazard and principal agent issues. Wildly inefficient system. No one would ever design it the way it exists now. On China, you have something of the opposite, which is that because so many of the on-the-ground decisions are made by local governments, and because the bureaucratic incentives are set up to kind of prioritize things like job creation and headline GDP generation, local bureaucrats, and I'm borrowing from the work of Lizzie Lee here, local bureaucrats have a strong incentive to keep factories going to maintain jobs if they're at that break even or kind of slightly loss-making level. So while it's true, I do agree with you in strategic sectors, in the EVs or solar panels, there is kind of really fierce competition. In some of those, older, industries of yesteryear, I think there's a lot of local capacity that's kept on life support because it would actually be more destructive for the town, for the municipality, for the province or whatever, for this factory, employing 20, 30,000 workers to suddenly go belly up. And I mean, China has a very understated, underappreciated amount of labor conflict. There's a great resource called the China Strike Tracker, if I'm not mistaken, or China Dissent Monitor, excuse me, which tracks labor disputes across the country, of which there are hundreds or thousands of incidents a year. Factories are still like a critical employment backbone for hundreds of millions of Chinese. And I think the incentives of local bureaucrats are to maintain that production even when it's not economical. So put these together side by side, the US that spends way too much with a super inefficient system in the healthcare sector, China, which produces perhaps way too much in inefficient ways for sort of bureaucratic reasons, they're sort of, they're much more like each other than maybe either side would like to admit.
Ethan, would you connect the narrative of incentives to keep employment or companies at zero profit or slightly loss-making levels with China's export capacity, or the companies that you're talking about are mostly geared toward domestic employment generation and domestic demand fulfillment.
Yeah, I think Chinese export strength comes from multiple tributaries. So it's not just this, but I mean, China has low labor costs for its development level. It has subsidized energy prices for factories. It has subsidized land prices for factories. Obviously has the weak currency, giving additional price support. That helps products in the sort of a lower value and mid value segments. And then at the high value, it's extremely technologically competitive. It produces an incredible amount of patents. It produces like an army of PhDs just by dint of its size. It has this incredible innovation engine. Those highly skilled workers who go through a brutally competitive education system are then thrown into heavily hierarchical companies where they're, not treated terribly well, but pushed really, really hard to produce. And they produce amazing stuff. And there are huge rewards in Chinese society on like a social level, on an interpersonal level for being the one that made it in the hyper-competitive society. Obviously, this is why so many Chinese are stressed out. That's why there's so much talk of 996 and nadren and lying flat and all that kind of stuff. But broadly speaking, at the high end, they have an incredible innovation sector and incredible talent and really just the greatest talent factory in the world, as far as I can tell. And then at the low end, they have a lot of insecure labor that will work for cheap cost with subsidized factories, subsidized energy, subsidized land, and local incentives to continue that capacity going. Throw on top of that, probably the greatest manufacturing industrial networks that the world has ever seen. Where suppliers can get a turnaround on a prototype in just a couple days and get, more prototypes than you even asked for across levels of sophistication of manufacturing. We've never seen anything like the Chinese manufacturing juggernaut because it really can do it all.
So, I really appreciate that differentiating that you just did. So I kind of wonder that when we go to like a Walmart in the US and you see a lot of knickknacks that are made in China, super cheap, from Christmas ornament to cheap furniture to toys, I can't imagine that those being the source of global current account imbalance headaches that permeate through the corridors of the IMF and Davos and so on. I think the imbalance that a lot of the economists and in the West are worried about is the imbalance of the high-end stuff. That do we really want to import all the EVs and all the generators and all the batteries from China? Well, then what is left for us to produce? We're kind of okay that they make the toys, but we're not okay that they make the fancy stuff.
Yeah, no, I think that's right. It's sort of because in America, and I'm just repeating myself here, there is not a clear articulation of priorities right now. We end up in this place where I think a bunch of discrete, conceptually distinct fears get lumped into one big kind of China scary narrative. And like, to be clear, China is scary in a lot of ways. Like, there are real reasons for the West to be concerned about security when it comes to China. I don't want to underplay that, but there are like distinct things that are happening. One, as you're saying, is like the question of would having Chinese phones or Chinese electric vehicles all over the US market lead to kind of issues with surveillance or tracking, or could China brick the EVs from abroad? That's sort of its, another one is like Chinese power inverters in the US electric grid. Could they shut off the electric grid with a cyber attack through their own inverters? That kind of stuff is sort of one basket of strictly security concerns. Then there are people concerned about sort of the David Autor China shock narrative that has to do with US deindustrialization and jobs. And that is about the lower end stuff. It's like, if we're making zippers in China, then we're not making them in Ohio, for example. And this was something Navarro talked a lot about in his great transshipment scam papers. He calls them the ugly sister cities, which are sort of like cities in different parts of the world that are trafficking Chinese goods to the U.S. and deindustrializing, particular parts of America. But that's an entirely different debate than like, are the Chinese radios listening to us, or are the Chinese power inverters going to blow up the power grid? And I think on that debate, the U.S. is, in my view, I think projecting some of its failures to adjust to globalization in the 2000s and 2010s. That people used to say globalization creates winners and losers, more winners than losers. Tax the winners, redistribute to the losers. Everyone's happy, everyone's better off. And we didn't do the last step of that. There were people that felt pretty significant distributional consequences. There were also all sorts of trade unrelated displacement issues that happened in the past 20 years in the US that we also didn't really adjust to. And so, yeah, there was a populist backlash, and China was the sort of convenient boogeyman for that. So I don't want to say there aren't issues. There are a lot of issues, but I think it's a lot easier to look at China and say, this is the source of our problems, than to look inward and say, actually, the US needs to, deal with all kinds of domestic economic issues. It needs to bring down the cost of like critical services. The laundry list is very long, but I think that's a much harder conversation to have.
Right. It is kind of interesting that, we wanted to have this conversation about Asia, but it's impossible to have a conversation about Asia without talking about the US. Ethan, the last part of the conversation was just fantastic. I really, really enjoyed it. Thank you so much for your time and insights. Don't be a stranger. We're going to bring you back on the show.
Yeah, thanks, Timmy, for having me. It's a pleasure to be on, and I hope I get to be on in the future. Maybe we'll bring some insights from East Asia next time.
Oh yes, and I'm really sad to recognize the fact that you won't be with us in Singapore for much longer. You're heading into the northern part of Asia, to Seoul to be exact.
That's right.
I'm jealous of your new adventure, but do share your insights with us.
Indeed, there will be plenty of defense industrial base in Korea to talk about after I've moved. So I look forward to doing it next time.
Absolutely. I'd like to thank our listeners as well. This podcast was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. Kopi Time is for information only and does not constitute any investment advice. All 183 episodes of the series are available on YouTube and on all major platforms, including Apple and Spotify. For our research content and webinars, you can find them all by Googling DBS Research Library. Have a great day.